Finding high probability targets using the DR trading strategy can sometimes be challenging, right? In this episode, I'll show you the top 7 trades from last week and break down exactly what outcomes you should expect under certain market conditions. Number 7, British Pound versus the Japanese Yen, Wednesday aftermarket DR session trade. Let's take a closer look at the price action in the forex pair British Pound versus the Japanese Yen. The day started off strong with a solid aftermarket DR session on Wednesday. The ADR closed as a red DR box and confirmed shorts with a higher probability for the session. Several clear rejections from the defining range lows provided a potential setup to target the next standard deviation level of 1.5. Moving into the ODR session, we saw another red DR box, but this time price quickly confirmed longs with a higher probability for the session. While this indicates a shift towards looking for longs, we need to keep in mind that the overall picture still points to a DR downside model being intact. This means we should be selective with our targets and remember that the ADR levels may be very sensitive to price action because of the DR downside model being intact. In this scenario, the higher you go with your targets, the lower your probability becomes. As price retraces back into the defining range, it rejects the IDR mid in line with the opening price 3 times. This is exactly the kind of rejection you want to see. With the ADR lows as a potential target, you have more than enough reward to enter the trade. Your stop loss should be placed right at the beginning of the retirement setup area for a potential second entry if needed. This is another beautiful trade, showcasing very clear rejections that signal an entry along with logical targets. Even though the DR downside model is still in play, these setups offer great opportunities with proper risk management. Number 6, Euro versus the US dollar, Monday overnight DR session trade. Let's continue with the Monday overnight DR session on Euro. The session closed as a red DR box, which as we know means the closing price of the defining range is lower than the opening price. Shortly after, we received a short confirmation, significantly increasing the probability for further downside price action in the session. At this point, it's a good idea to switch over to the 6E currencies futures chart to gather some extra insights. On the futures chart, we can see that the recent move to the downside left behind 2 open magnetic volume imbalances. One of these imbalances lines up with the DR low, while the other is located near the closing price. Returning to the spot market chart, we can highlight these imbalances roughly, as they can act as magnets for price, giving us extra confluence for potential retracements back into the DR. Let's quickly summarize what we have so far. A red DR box, a short confirmation, the 0.5 SD level already reached, and the 6E futures correlation for the open volume imbalances. Now, as price returns back into the DR, it rebalances both WIBs, which is where you want to take action. If you're playing your shot here, make sure to cover the beginning of the retirement setup area with your stop loss. This allows for a potential re-entry if you get stopped out, offering an even better risk to reward on the second bullet. As for the target, you can either aim for a new low or the next standard deviation level, whichever gives you at least 3 Rs. This was a beautiful trade opportunity with plenty of confluences lining up. It also highlights the importance of using the currencies futures chart as an additional layer of analysis. There are often hidden gems to be found there that can significantly boost your confidence in the setup. Number 5, gold futures market, Thursday aftermarket DR session trade. Let's have a look into the Thursday aftermarket DR session in gold. The session begins with the ADR forming a red DR box. After the box formation, we notice that price rejects the closing price decisively and doesn't show any intention of breaking below it. Price then pushes higher and confirms longs with a higher probability for the session with the 9 p.m. candle. By this time, the plus 0.5 SD level has already been reached with the confirmation candle. Within the DR, we also have an intraday gap imbalance, and above there's an open magnetic volume imbalance giving us some potential targets to aim for. A quick glance into QuantX shows that for this exact scenario, historically, price has reached the 2 standard deviation level 70% of the time if the session holds true. This lines up perfectly with the open magnetic whip above. As price continues to push higher, it fails to rebalance the open magnetic whip and returns all the way back to the closing price and the retirement setup area. This is your opportunity. Your stop loss can either be placed just below the DR, or if you want to be safer, include the previous day's RDR IDR as it lines up perfectly with the current setup. Your target is clear, and there's also another open magnetic whip that was left behind by price during the retracement. This setup truly can't get any better. It's a picture-perfect retirement setup with a strong potential for 5R, definitely worth taking. Join me as I teach thousands of students how to trade like a professional. Learn how to trade the DR trading strategy combined with data, get access to exclusive tools and indicators, weekly live trading sessions where you also get deep market insights, which have never been taught in the retail space before, and a lot more. Visit m7dr.com for more information. Number 4. British pound versus the US dollar, Tuesday overnight DR session trade. Let's get into the Tuesday's price action for the British pound. The session began with a solid ADR session confirming longs and rejecting its highs before pushing higher. The relationship between the ADR and ODR session points towards a DR upside model. However, in the overnight DR session, we got a short confirmation. Following this, price retraced back into the defining range and rejected the opening price 3 times within the retirement setup area. This is where things get interesting. Let's switch over to the British pound futures chart. Here it's clear that price isn't closing above the opening price, and we also have an intraday gap imbalance lining up. This area could act as a barrier for price during this session, adding another layer of confluence. Switching back to the spot market price chart, we can begin to look for potential targets. We have multiple confluences for this trade. The red DR box with a short confirmation, a retracement back into the retirement setup area, and the intraday gap imbalance from the futures chart. As always in a retirement setup, your stop should be placed above the DR, since we don't want price to close above and confirm a false DR session. Given that we are still in a DR upside model, it's important to factor in that the ADR levels remain very sensitive to price action. The ADR highs, in line with the 1 standard deviation extension, look like promising targets here. Keep in mind that the lower we go into the ADR, the lower the probability becomes because the upside model is still intact, but it's not completely out of reach. This retirement setup right here rewards us with a potential of more than 3R, targeting the 1 standard deviation level. Price makes one more push higher to the IDR high, but quickly finds its way back below the opening price. This presents another opportunity to take the trade with an even better risk-to-reward ratio. As the ODR session comes to an end, you can either close your position here or move your stop to break even to reach out for your initial target. Another well-calculated trade with the probabilities stacked in our favor. Number 3, Euro versus the Australian dollar, Friday aftermarket DR session trade. The Friday aftermarket DR session on the Euro versus the Australian dollar closed as a green DR box, followed by a long confirmation with the 8:50 p.m. candle. If you've been following along with the previous videos, you already know what to expect when you see a confirmation like this within the first hour of the ADR session for this pair. Historically, the probabilities are high that price will reach a minimum of 2 standard deviations if the DR session holds true. Right after the confirmation, price retraced below the IDR mid and rejected both the opening and closing price before pushing higher, reaching almost 2 standard deviations. This move was hard to catch, no doubt about that, but the opportunity wasn't completely gone. Later in the session, price retraced back into the DR and quickly found its way above it again, giving us another chance. This time we get a beautiful rejection of the IDR high, and it's the last point where you would want to enter. Your stop loss can cover the opening and closing price of the DR as long as it still offers more than 3R. The target is clear, the next standard deviation level, which is also a high probability target according to historical data if the session holds true. This kind of setup in the ADR doesn't form often on the Euro versus the Australian dollar, but when it does, it tends to reward you respectfully. Number 2, US dollar versus the Japanese yen, Wednesday aftermarket DR session trade. Let's break down another DR trade. The Friday intraday cycle kicked off with a false ADR session, which led to a significant move to the downside. Following this, the ODR session opened and closed as a green DR box. A few minutes later, we got a long confirmation as price closed outside of the defining range on a 5-minute time frame. At around 5:20 a.m., price made a deep retracement back into the DR, and this is where we start looking for a retirement setup. Now, while we do have a green DR box and a long confirmation, it's important to remember that we should manage our expectations and not aim for overly high targets just yet. This caution comes from the fact that the relationship between the ADR and ODR still suggests we're in a DR downside model. The key here is that all ADR levels are being respected by the ODR. For this setup, the stop loss should be placed below the defining range, as this setup offers a higher probability of price closing above the DR in a long confirmation scenario. While we can look towards the next standard deviation level as an optimal target, don't forget that the ADR levels also come into play as potential targets. However, the higher we aim for targets within the ADR, the lower the probability becomes due to the DR downside model intact. It's important to understand that the one standard deviation level target offers a potential 3R, which is exactly what we're aiming for in this setup. As price pushes back above the DR, we're seeing clear rejections from the DR highs, indicating a willingness to move higher. At this point, the session comes to an end and you're either already in profit or have the option to trail your stop aggressively to secure some profits and potentially aim for higher targets. Whether or not you choose to trail your stop for even higher gains, the foundation of this setup was a beautiful retirement setup with logical target selection and well-managed expectations throughout the trade. And we're coming to number 1, S&P 500 futures market, Monday regular DR session trade. First, let's take a look at the bigger picture. We can see that all 3 DR sessions have formed and each one respected the previous DR session levels while taking out their respective highs. This is a textbook example of a DR upside expansion model formation. What's even more important is that all 3 sessions formed a green DR box, indicating that the closing price is higher than the opening price in each case. This is a strong signal for potential further upside price action. Now here's where it gets interesting. The RDR session confirmed shorts with the 10:40 a.m. candle. The next 2 candles then retraced back into the DR. So the big question is, would you take a short here? Is this really a high probability setup? Let's analyze further. We have 2 open magnetic wibs from the overnight DR session that haven't been rebalanced yet. So what's the expectancy here? Your stop loss should definitely cover the IDR low, which aligns with the opening and closing price of the session. As for the target, you might initially aim for the next SD level of 1, but keep in mind that the ODR mid and ODR low are still acting as strong barriers for price. This is critical because the DR upside model remains intact unless the RDR breaks below. Even if you target the open magnetic wibs, the risk to reward isn't good in this scenario. The conclusion is clear. It's better to stay away from this trade unless you see a deeper retracement into the retirement setup area. Only then might it be worth considering a short, depending on the situation. Price drops lower and retraces all the way back into the retirement setup area. If you're still thinking about a short here, it's the wrong move. The ADR lows remain intact and haven't been broken, meaning the upside expansion model is still valid. Finally, price finds its way back above the DR, confirming a false session. This is a perfect example of how to minimize risk and know when to trade and when to sit out. The DR models provide excellent insights into when to preserve capital in low probability environments and when you can capitalize on high probability setups. As always, I hope you enjoyed this video and gained some new insights that will improve your trading. Don't forget to like the video and share it with your DR trader friends. Have a good trading week.
We're gonna take on the world.